Welcome! Today, let's explore why gold has fascinated people for centuries. Investing in gold means owning a piece of this precious metal, hoping its value rises over time. Unlike company shares, gold is about holding something ancient and valuable. Many turn to gold for protection. It's like a financial safety net. Gold also helps fight inflation, keeping its value when money loses buying power. Over generations, gold has held its worth, making it a reliable way to preserve wealth. Adding gold to your investments is smart diversification, spreading your risk. When other assets fall, gold can rise, helping balance and protect your wealth. The classic way to invest in gold is by buying the physical metal itself, bars or coins. These are investment-grade items valued for their gold content, not for spending. Popular coins include the British sovereign, South African Krugerrand, and Canadian maple leaf. Physical gold gives you a tangible asset you control, outside digital systems. You decide where to store it, but security is crucial. Most investors use a quality home safe or a bank safety deposit box. Insurance is recommended, adding to your costs. Dealers charge a premium above market price when you buy and pay less when you sell. This spread means gold must rise in value before you profit, and it can be less liquid than other investments. For those who like the idea of owning gold but do not want the hassle of storing and insuring it, there is a much more modern solution. You can invest in gold through special funds, which are often called exchange-traded funds, or ETFs. Think of these like a big pot of gold that is held securely by a financial institution. You can buy a small share of that pot. Your share represents ownership of a tiny amount of the gold in the vault. These shares are traded on stock exchanges, just like the shares of a company, making them incredibly easy to buy and sell. One of the biggest benefits of investing in a gold ETF is the convenience. You can buy or sell your shares with just a few clicks through an online brokerage account. You do not have to worry about finding a reputable dealer, arranging for secure delivery, or paying for storage and insurance yourself. A very popular example of this is the Spider Gold Shares ETF, known by its ticker symbol GLD. It is one of the largest and most well-known gold funds in the world. This simplicity and low cost of entry make it an accessible option for people who are just starting their investment journey. Furthermore, gold ETFs are what we call very liquid. This means you can turn your investment back into cash very quickly and easily. Because they are traded on major stock exchanges throughout the day, there are always people looking to buy and sell. This is very different from physical gold, where you might need to find a dealer who is willing to buy your specific coins or bars at a fair price. The liquidity of ETFs gives you flexibility, allowing you to react quickly to changes in the market or to access your money if you suddenly need it for an emergency. Of course, there are also things to be mindful of. When you own shares in a gold ETF, you do not actually own the physical gold yourself. You own a promise from the fund provider. While these funds are heavily regulated and the gold is held in secure vaults, you are still relying on that institution to manage it properly. You also have to pay a small annual management fee, known as an expense ratio, which covers the costs of running the fund, including storage and security. Though these fees are typically very low, they are a continuous cost that slightly reduces your overall returns. There is another, more indirect way to invest in gold, and that is by buying shares in the companies that mine it from the ground. When you buy shares in a company like Barrick Gold or Newmont Corporation, you are betting on the success of their business operations. The thinking is that if the price of gold goes up, these companies should become more profitable because the product they are selling is suddenly worth more. This can lead to a significant increase in the value of their shares, often providing a much greater return than you would get from just owning the gold itself. This potential for higher returns is the main attraction of investing in gold mining stocks. It offers what is known as leveraged exposure to the gold price. A small increase in the price of gold can have a much larger impact on a mining company's profits, and therefore its share price. If a company can mine gold for 1,000 pounds an ounce, and the price of gold rises from 1,500 to 1,600, its profit per ounce has just increased by 20%. This can make mining stocks a very exciting investment during a gold bull market. offering a chance for substantial gains. However, this path comes with a much higher level of risk. When you buy a mining stock, you are not just exposed to the price of gold. You are also taking on all the risks associated with running a large, complex business. The company could face problems with its mines, such as a collapse or a flood. It might have to deal with strikes from its workers or political instability in the country where it operates. The company's management team could also make poor decisions that hurt its profitability. Any of these issues could cause the share price to fall, even if the price of gold is rising. So, to wrap everything up, investing in gold can be a very smart move to protect your money and add stability to your portfolio. You can choose to hold the physical metal in your hands, which gives you ultimate control, but comes with storage costs. You could opt for the convenience of a gold ETF, which is easy to trade, but means you do not own the metal directly. Or, if you are willing to take on more risk for potentially higher rewards, you could invest in the companies that mine the gold. The right choice for you depends on your own financial goals and your comfort with risk.